Hello, and welcome to our intermediate course on Forex trading. Today, we're diving deep into some economic indicators that go beyond the basics. Understanding these indicators can give you a sharper edge in the Forex market as well as a better understanding of the risk. Let's get started. Economic indicators are statistical data points that provide insights into the overall health, trends, and future direction of an economy. These indicators are used by policymakers, investors, traders, and economists to assess economic performance, predict future economic activity, and make informed decisions. Some of these indicators are employment reports. Employment reports are critical indicators of economic health. The most watched among them is the non-farm payrolls report in the United States, which is released monthly. This report provides data on the number of jobs added or lost in the economy, excluding the farming industry. A strong employment report showing significant job creation typically indicates a healthy economy and can lead to a stronger currency. Conversely, weak employment data can suggest economic troubles, leading to a weaker currency. Additionally, unemployment rates, average hourly earnings, and labor force participation rates are key metrics within these reports that can provide deeper insights into the labor market's health and its impact on currency values. Strong employment data, such as high NFP, often suggests increasing inflationary pressures as more jobs lead to higher consumer spending. This can prompt central banks to raise interest rates, strengthening the USD. For example, the US non-farm payrolls report for March 2021 showed a significant increase of 304,000 jobs from 527,000 in February to 831,000 in March. This strong job creation indicated a robust economic recovery as the US emerged from the pandemic, leading to a notable strengthening of the USD. Retail sales. Retail sales data measures the total receipts of retail stores and is a vital indicator of consumer spending. As consumer spending accounts for a large portion of overall economic activity, strong retail sales figures indicate economic growth and can support a stronger currency. Seasonally adjusted retail sales figures are particularly important as they smooth out seasonal variations and provide a clearer picture of underlying trends. For Forex traders, rising retail sales can signal a robust economy and potential currency appreciation, while declining sales might indicate economic weakness and a potential depreciation of the currency. Strong retail sales reflect rising consumer demand, which can drive inflation. As inflation rises, central banks may raise interest rates, supporting a stronger currency. For example, in March 2021, US retail sales surged by 11% month over month, rebounding strongly after a decline in February. This increase was driven by stimulus checks and eased restrictions, signaling strong consumer spending and contributing to the positive momentum for the USD. Housing market indicators. Housing market indicators such as housing starts, building permits, and existing home sales provide insights into the real estate sector's health. The housing market is closely tied to economic conditions as it affects consumer wealth, spending, and confidence. Strong housing market data can indicate economic growth and bolster the currency. For instance, rising housing starts and building permits suggest increased construction activity and confidence in future economic conditions. Conversely, a slowdown in the housing market can signal economic troubles and lead to a weaker currency. A growing housing market can indicate increasing consumer wealth, potentially fueling inflation. This can lead to interest rate hikes, which in turn strengthen the currency. For example, in March 2021, US housing starts rose to a seasonally adjusted annual rate of 1.67K thousand units, up from 1.41K thousand units in February. This surge in construction activity indicated strong confidence in the housing market and broader economic growth, further supporting the USD. The Consumer Confidence Index, or CCI, measures the degree of optimism that consumers feel about the overall state of the economy and their personal financial situations. The CCI is based on surveys that ask households about their expectations for business conditions, employment, and income over the next 6 months. A high CCI indicates that consumers are optimistic and likely to increase their spending, which drives economic growth. On the other hand, a low CCI suggests that consumers are wary about the future, leading to reduced spending and potential economic slowdown. High consumer confidence suggests increased spending, potentially raising inflation. Central banks might raise interest rates to curb inflation, leading to a stronger currency. For example, The US Consumer Confidence Index increased to 109.7 in March 2021, up from 90.4 in February. This jump reflected growing optimism about the economy as vaccine distribution expanded, contributing to the strengthening of the USD as consumers were expected to increase spending. Purchase Managers Index. Next, we have the Purchasing Managers Index, or PMI. This indicator is derived from the monthly surveys of purchasing managers in both the manufacturing and service sectors. It provides a picture of the economic health of these key sectors by measuring factors like new orders, inventory levels, production, supplier deliveries, and employment. A PMI reading above 50 indicates expansion, while a reading below 50 suggests contraction. Consistently high PMI values point to robust economic activity and can bolster a country's currency. Conversely, declining PMI values can signal economic trouble ahead, which might weaken the currency. A high PMI indicates economic expansion and can be a precursor to rising inflation. This may lead to higher interest rates, boosting the currency's value. For example, the Eurozone manufacturing PMI for June 2021 reached 63.40, the highest level since the survey began in 1997. This strong expansion in manufacturing activity indicated robust economic growth in the Eurozone, providing some short-term support to the euro. Industrial production. Industrial production measures the output of the industrial sector, including manufacturing, mining, and utilities. This indicator is important because it reflects changes in production levels which can influence GDP and overall economic health. Increases in industrial production typically indicate economic expansion and can strengthen the currency. On the other hand, declines in production may signal economic slowdown and potential currency depreciation. Monitoring industrial production helps traders understand the health of the industrial sector and its impact on the broader economy. An increase in industrial production can signal economic growth and inflationary pressures, which may lead to higher interest rates and a stronger currency. For example, the US industrial production rose by 2.8% in March 2021, recovering from a decline in February caused by severe weather disruptions. This increase in production reflected ongoing recovery in the industrial sector, further bolstering the USD. Government debt. Government debt and budget deficits are important indicators of a country's fiscal health. High levels of government debt can lead to concerns about a country's ability to repay its obligations, potentially weakening the currency. Conversely, a country with low debt levels and a balanced budget is generally perceived as having more stable economic environment, which can strengthen its currency. Monitoring government debt and deficits provides insight into a country's fiscal policies and their potential impact on currency valuation. High government debt can lead to inflationary concerns if debt is financed through excessive money creation. Rising inflation may trigger interest rate hikes, affecting currency strength. For example, in March 2021, concerns about the rising US government debt were overshadowed by the positive impact of the $1.9 trillion stimulus package, which fueled economic growth. Despite the high debt levels, the strong economic data from other indicators led to a stronger USD. Yield curve. The yield curve is one of the most closely watched economic indicators. It plots the yields of government bonds across different maturities. Typically, the yield curve slopes upward, meaning long-term bonds have higher yields than short-term bonds. This makes sense as investors demand higher returns for locking their money away for a longer period. However, when the yield curve inverts, it means short-term yields are higher than long-term yields. This inversion is a powerful predictor of economic cycles and often signals an upcoming recession. Why? Because an inverted yield curve suggests that investors are worried about future economic growth, leading them to seek long-term safety despite lower returns. Historically, an inverted yield curve has preceded recessions. A steepening yield curve often signals rising inflation expectations, which could lead to interest rate increases. This strengthens the currency as investors seek higher returns. For example, in March 2021, the US yield curve steepened significantly, with the spread between the 10-year and the 2-year Treasury yields reaching its widest level since 2015. This steepening was driven by expectations of strong economic growth and rising inflation, contributing to the USD's strength as investors anticipated future interest rate hikes. When analyzing how economic indicators impact the Forex market, it's crucial to consider the difference between expected or forecasted data and actual data. This gap can lead to significant currency fluctuations. If actual figures differ from what was predicted, it can trigger sharp movements in currency pairs as traders react to the unexpected news, adjusting their positions based on the perceived strength or weakness of a currency. As always, remember that successful trading requires continuous learning and staying updated on the latest economic developments. Stay tuned for our next lesson. Happy trading!